Hello everyone, this is Poonam Singh and today we are going to start macroeconomics chapter number 1, national income. Under this chapter, today we will cover the new topic, that is basic concepts of national income. This is the chapter of class 12, so let's get started. The first topic which we are going to cover, that is depreciation. As we already know what depreciation is, but still, so here it says that depreciation is charged on what? It is charged on fixed assets. Fixed assets are those kind of the assets which are being used for 1 year or more, or you can say it as for longer time duration, just like machinery, land, car, etc. Here it is written that when you have to go from gross value to net value, then you have to less depreciation or deduct depreciation. But when you will go from net value to gross value, then you have to add depreciation. Now the question arises, what is gross value and what is net value? So let's understand this with the help of example given below. Here in the example it says a car was purchased at rupees 1 lakh. How much? 1 lakh. And was sold at rupees 75,000. So the purchasing price of the car is 1 lakh and the price at which it has been sold is rupees 75,000. So the price at which the car was purchased is known as gross value. What it is known as? Gross value. And the price at which it has been sold, that is 75,000, is known as your net value. Now what we have to do? We have to calculate depreciation. So as we know that if you will deduct from purchasing price or from gross value the net value, you will get depreciation, that is 25,000. Now let's come to this concept of gross value to net value. So how we can understand it? Here it says that if suppose the gross value is given to you, right? But you do not have the net value and you have to calculate it. And in this case, along with gross value, you also have the depreciation in the question. So then what you will do? You will deduct depreciation so as to get net value. So let's see, are we going to do that? So 1 lakh is your gross value. You have deducted your 25,000 as depreciation. You got the net value. What is the net value? 75. Is that so? Yes. Then if suppose in the question net value is given to you and as well as the depreciation is given to you and you have to find out the gross value, what you are supposed to do? You are supposed to add. What you are going to add? You have to add depreciation. So let's see, are we going to add it? Let's see, as the net value is 75,000 and the depreciation is 25,000. These both are added together and you got, what you have got? You have received your 1 lakh rupees as gross value. So definitely this concept is now very much clear to us. It says that if suppose gross value is given and you have to go to net value, what you will do? You will deduct it as we have deducted here, right? And when from net value to gross value you will go, then you have to add depreciation. I hope this question is clear to you. So let's move on to the next slide. So the next topic which we will discuss here is about, what it is about? It is about net indirect taxes. So as far as net indirect taxes is concerned, we have already known about indirect taxes, which is included in GST now, right? All the indirect taxes are known as GST now, or are comprised in GST now. But what is net indirect taxes? So definitely it is the tax which is paid to the government on resources used. So whatever the resources you have used or utilized, for that you need to pay taxes. That is known as net indirect taxes. Under this topic we have received two new terms, that is factor cost and market cost. Now the question arises, what is your factor cost? What is your market cost, right? So let's understand this with the help of example that is given below. So here in the example it says the production cost of the goods is rupees 1000. How much it is? It is rupees 1000. And that NIT, what is NIT? NIT is this, your net indirect taxes. So NIT is charged at the rate of 20%. So what are you going to do? You will charge this 20% on 1000, as you can see here. Right, what you've received 200. This 200 is what? 200 is your NIT. It is NIT. Okay, now if we will go here, the concept says from factor cost to market cost. If you will go, what you will do? If from factor cost to market cost you are going to go, then what you have to do is you have to plus NIT. Let's see, are we doing that? This is factor cost and this is MP. MP is your market price. MP and MC both are same, whether you call it as market price or market cost. Okay, so you have to calculate this MP. It's written also. You have to calculate MP. So factor cost is 1000, written here 1000. Okay, then you have to add. It's written add. So you have added NIT with 1000. You got 1200 rupees. That is your MP or market cost. Now in order to derive your factor cost, what you will do? Factor cost, if you want to derive and you have market cost, so what you have to do is less NIT. So this is market price 1200. Just now we got it. 1200 minus 200. You will receive again your factor cost. So this is all about your net indirect taxes. So as far as net indirect taxes is concerned, when you will go from factor cost to market cost, add NIT. When from market cost to factor cost, less NIT. This is given here in the example very clearly. Now one thing very important, if suppose in the question NIT is not given to you, then what you will do? Then no need to worry, go through this note. It says that if NIT is not given, then use formula, that is indirect taxes minus subsidies. Now indirect taxes, already I said GST, and then you will get your net indirect taxes. I hope this is clear to you. So let's move on to the next slide. Now here in this case of what we say is, that is your net factor income from abroad. What I said is net factor income from abroad. As far as net factor income from abroad is concerned, definitely factor income is that income which we have already discussed. We call it as income, that is earned income, when you receive as a part of your you can say it as when you have provided your services, and in return when you receive any income in monetary term, that you call it as factor income. Now this factor income is generated from abroad, right? What you are going to do with it? So let's see. We are getting two terms here which we have already discussed in the previous videos, that is net income and you can say it as domestic income and national income. Domestic income, let me have the recap of it. Domestic income is that income which is earned by the resident or non-resident of a particular country within the country. And national income is that income which is earned by only resident of the country, whether inside the country or outside the country. So if suppose you have domestic income and you have to calculate national income, then you have to add what? Net factor income from abroad. Okay, but if suppose national income is given and you have to calculate domestic income, then you have to deduct net factor income from abroad. The reason is because in case of national income, why we add net factor from abroad in net factor income from abroad? The reason is because we add income from the country also and from abroad also in national income. But in case of domestic income, only the income which is generated inside the country is being used. So that is the reason while calculating your domestic income, we will not include any income which is generated from outside the country until unless it is not the part of our domestic territory. Okay, so let's understand this topic very clearly with the help of the example given below. It says that suppose domestic income earned is rupees 10,000 and 5,000 rupees is from abroad you have earned. Okay, now you have to calculate your national income. So let's see, national income I have to calculate. I have NFIA also, net you can say it as factor income from abroad. This is, so here it says that DI to NI. So for DI is your domestic income 10,000 rupees plus 5,000 rupees, you will receive 15,000 as your national income. But if national income is given and domestic income you have to calculate, then from this 15,000 as your national income you have to deduct 5,000 rupees, that is your income from abroad, and you will get domestic income, right? So I hope this topic is also clear to you. Thank you so much for watching.